How's it going, everybody? It is Dennis, and we're back with another video talking about hedging. Like we mentioned in the last video, we're talking about hedging and how you could use this in your options portfolio, in your high yield portfolio, in your margin portfolio, or if you're doing all three together, all three different strategies, how this could help your portfolio when it comes to downturns. Of course, right here we have the S&P up on the screen. It's up 0.82% today, 0.808% after market. On the year to date, it's up 10.2%. We're reaching all-time highs. We consistently beat records after records after records for the S&P, which is great, nice and dandy, but still there is always that chance of downturns like we had during the tariff drama, like we had during, of course, COVID times. There's times where there will be downturns. There will be times where there's high volatility and things just go south. And those times you need to have a hedge. And not like the usual hedges where we see hedge funds do, where they buy a stock and they hedge against a different stock. No, we are hedging over the overall market to save your or my portfolio, in this case, my portfolio, in times of downturns. And what hedge do I currently have? Well, that is this hedge right here, which actually, I don't know why it's a white screen. Let's go ahead and refresh it. This hedge right here, which is a 585 put on the S&P, currently valued at $94. I bought it for $154. As you can see, I am down on this hedge so far because the market is ripping, which is great news for me because my portfolio is ripping as well. My portfolio is going up, but I'm still hedged and I'm still protected a little bit. Not my whole portfolio is protected, but a little bit of my portfolio is protected in case there is a hard downturn, right? This is great to have in case we have another tariff drama, in case we have another situation like COVID or anything of that sort where we have strong drops down, or maybe 2008, another bubble, or anything of that sort. When there's hard drops down and the volatility goes up, this is where these hedges win. So, how am I hedging? What am I doing? Well, currently I'm using around 5% of what my current income is every single month to hedge against my portfolio. I might go up to 10%. I'm not quite sure yet, but it's 5 to 10%, and I hedge every single month. The reason I hedge every single month, or I'm planning to hedge every single month, is because my income varies month to month. So one month, 5% might be like this time, $154. Another month, it might be $200. It might be $300. It might be less. So I'm hedging month to month. It gives me the ability to choose the best option for me depending on what my income was on the previous month or this month that's coming up. So I'm able to hedge appropriately depending on how the movement of the account goes. So, as you may or may not know, I did the update video of how much I earned for August, and that was $2,872.82. So that $154 I spent on the hedge was around 5.3% of my overall income. Not my portfolio, but my income. So I'm hedging based off the income that I earn. Now, how would this hedge work when it comes to downturns? Well, we could easily take a look at the sheets. So if we go ahead and change these numbers really quick so we can see a better understanding of what's happening, let's go ahead and bring this down to 550. So this is the current position that I have, right? So $154, October 3rd expiration, 585. Currently, if the market drops 10%, right? So 10.35% is the closest we could get. Say it drops somewhere in the middle of the month, I would make around $1,000 to $1,300, right? If we wait till the end, I'll make a lot less because of Theta. Theta affects your returns quite well. But if we wait till the end, towards the end of the month, we'll make around $1,000, let's say. So say $1,000 is how much we would earn if we have a 10% drop. That 10% drop usually comes with a 30% IV change, right? So plus 30%. This is based off, of course, we ran this through ChatGPT because it's the best way to pull up historical information as well as statistics. So on a 10% drop, we have around from a 25 to a 30% IV change. 20% drop, we get a 35 to a 45% IV change, and the 30% drop, we get a 50 to 80% IV change, right? So going off the first 10%, that's 25 to 30% IV change. We went with the 30% because that's what historically has been around 28 or 30%. So 30% IV change would yield us around $1,000 in case we had a 10% drop. How much will I lose on my portfolio on a 10% drop? Well, I'll lose around $8,500. So that means I'm giving myself $1,000 worth of space. And now instead of losing $8,500 for 10%, I'll lose $7,500 or around 8%, right? So 2% I'm gaining on the moments of downturn. Also, another great thing when it comes to these hedges, you do not have to give up all of your money to hedge it, right? So usually people go, instead of hedging, just hold cash. So in case there are downturns, you could buy into positions for cheap using that cash. But if you're holding cash, what does that mean? You're withholding cash to reinvest back into your portfolio, therefore slowing down your compounding, slowing down your growth, and not fully utilizing all the cash that's in your portfolio. Having a hedge like this where you spend $150 or 5% of your total income every single month, you're able to create a cash supply in case there's a downturn to where you're able to pull out that cash and then spend it. So it's like insurance for your portfolio. That's what hedging is. It's insurance for your portfolio. So in case there's a 10% drop, as we saw right here, I'll get $1,000 worth of insurance money, right? So I gave $150 up that I probably will lose, right? I'll probably lose in case the market keeps going up. So I'll lose $150. I have a chance of losing $150 or 5% of my monthly income. But if the market goes down, my insurance kicks in and I get $1,000 in cash that I could pull out and use to reinvest in the portfolio. This is $1,000 I could buy cheap stocks and ETFs and options. And therefore, when the market goes back up, my rate of return will be a lot higher, right? I'll recover a lot faster. It's because I bought and lowered my average cost. This is also not including, since I have a dividend and option portfolio, I'm earning income on a monthly basis. So that dividend that I'm getting on a weekly or monthly basis will also be reinvested back in and will also lower my average cost dramatically. General, we're focusing on, of course, the hedging part of this. So $1,000 is roughly how much I would get in cash from this position. Now, if I was feeling a little bit more interested in hedging, and I really think the market is going to crash sometime soon, I might go ahead and throw in 10% of my income. If I threw in 10% of my income, so let's go ahead and reset this really quick. So let's go ahead and 650 and do the 550 range, right? So we go to this range again, and we go ahead and take a look. If we had a 10% drop, and we bought a put, so this is the same October 3rd put, but at $605 now, and we're spending roughly $300 on this. So this would be 2 times the amount we spent before, so roughly 10% of my income. And we had a 10% drop, we would earn around $2,000. So the more I spend, the more I earn, right? We're able to earn now $2,000, roughly $2,000 to $2,500, depending on when this drop occurs. And with that, I'm able to take that $2,000 and purchase more shares at lower average cost. So I put up $300 every single month. That'll be 10% of my monthly income, and I'm able to get insurance of roughly $2,000. Now, how am I trading these options, right? When am I purchasing these puts? How am I trading these puts? And why is it set for October 3rd rather than September 29th? Since September 29th is the end of September, shouldn't I have it on that month? Well, actually, the way I'm running it is I'm actually setting it a week over, right? So I'm putting it into the next month over for September or for that month that's coming up. So right now we're going to have October coming up. Instead of having the expiration date in October, I'll have the expiration date in November. The reason for that is because there's something called Theta. Due to Theta, right, the amount that our options will bring us in income decreases dramatically. Right, so if we take a look on the 29th, this is technically the last Friday of the month, we will be making $672 at a 10.35% drop. Just a week after, we'll be making $146 at a 10% drop at the expiration of October 3rd. That is a dramatic decrease. That's a 4 times decrease pretty much of how much we would be earning if we waited for that negative 10.35% drop a week after. Now, what I'm doing to combat that is October 3rd is when the expiration would end, right? So October 3rd is when either I win or lose, and if I lose, it's okay. I'll just run it again, right? If I win, I win. But what I'm doing is I'll just buy myself another put on September 29th. So on September 29th, a week before, I'll buy another put. So just in case something occurs between 29th and the 3rd, I'm safe because I now have this new put that will cover me in case there is a market fall. So I'll be covered in case there's a market fall. And of course, if the expiration, if there's a market fall, I'll be covered on the new put I purchased, right? So Theta will have no effect on what occurs, right? If I didn't purchase that new put on September 29th, I would only be making $146. But if I purchase another put on September 29th, I'll be able to capture all that income. For example, if I bought another put right here, and the first day that I bought, first week that I bought it, I'll be making around $2,000 on the drop. So it keeps me safe in case of scenarios like that, where Theta kind of works against you and you might not be timed correctly if you wait a little bit too long to buy the next put. And then you'll end up in a situation where Theta has eaten away on your options, and then there's a 10% drop, and you're actually making nothing from it. So that's currently how I'm looking at it, how I'm trading. Now, how would this work out when we have a 20% drop or a 30% drop, right? So we go ahead and go to and change our numbers here really quick. I don't know why the website's bugging out, but we change our numbers here really quick, and we put this to the 500 range, right? So let's go ahead and put it down to 500 if it allows us. If we have a 20% drop, how much are we looking to make at a 20% drop, right? First of all, before how much we'll make at a 20% drop, how much will we lose at a 20% drop? I'll lose around $17,000 on a 20% drop in the market. Now, how much would I make on a 20% drop on the market with my 5% of my income being used? Say it happens somewhere in the middle of the month, I'll make around $6,000 to $6,500 in profit. And of course, if it happens at the end of the month, I'll make $6,800 at the end of the month. So as you can see, Theta here doesn't really have that much of an effect, right? It starts losing its effect the more you go into profit. So at a 20% drop, I'll make her anywhere from $6,500 to $6,000 in profit. Say we make $6,500 in profit, we're saving us $6,500. That brings us to a total loss of course, $1,500, right? $10,500 is how much we will lose in total value. So instead of a 20% drop, we're more close to an 11 to 12% drop, right? We're saving us 8% in loss. So as you can see, the stronger the drop, the more you'll make, obviously, right? That makes sense, right? But this is not calculated as well. This is still at 30% IV, which is the estimate that we would have for a 10% drop. Now, say we switch this for a 20% drop, which is on average 35 to 45. So let's go ahead and move this up to 40%. So let's go ahead and go here, and let's go ahead and scroll this up to a 40% drop. All right, let's go ahead and change this to 40. Let me just type it in. It'll probably be simpler. Let's say there's a 40% IV change. The VIX spikes up to 40%, right? How much would we make with that new spike? We would make, oh, actually, it's the same. Surprisingly, 6,700 to 6,800. So not much change at that point when you have a 40% IV change. So that's good to know. But if we take a look at the 10%, right? So let's go ahead and change the numbers for the 10% of our income being invested. So we had 10% of our monthly income invested. How much would we be saved on a 20% drop? If we had 10% invested of our income every single month, we would make $8,600 to anywhere to $8,700 or $8,500. So say it's at $8,500 respectively. Let's go ahead and move this also up to 40 as well, so we could get a little bit of better numbers. So 8,600, 8,500 is our numbers. So say we had an $8,500 or a 20% drop, and we made it $8,500. We would actually be sitting around $9,000-ish, $9,500-ish in total loss, right? So we'll be close to almost 10% of a drop. We'll be getting close. We'll be at like 10% to 11% of a drop, while before it was like a 13% of a drop. So we're saving us almost double digits in percent when it comes to having a 20% drop, right? This is using 10% of my total income in my portfolio. This $8,000, don't forget, and the last $6,000, don't forget, we could take that and funnel it back into the portfolio. We could sell out of this position in case there's this drop, put it back in the portfolio, and use that to buy our ETFs that we love and trust at a lower average cost. And with that, we could take that money and go ahead and, like I said, grow, right? So instead of holding cash, large amounts of cash, like imagine holding $8,500 in cash and it's just sitting in your portfolio and doing absolutely nothing. Here, you're using $300 in my example every single month to get yourself an insurance claim of $8,500, while the money that you would have been withholding in cash could be used to keep purchasing stocks, keep purchasing ETFs while the market continues to trend upwards. Like I said, this is a hedge. This is not something you should be using, you know, for your whole portfolio and like going it all in, right? This is a hedge. It is meant to possibly lose, and it's meant to probably lose, right? You're probably going to lose if the market continues to trend upwards. But in the case that there's a market downturn and you decide to put more of a hedge in, 10-15% of your monthly income, you go ahead and put that in. You're continuing to reinvest the other percent of your income. So say you put 10%, the 90% you earn in income will go back into portfolio and continue to grow the portfolio. This 10% you will lose, right? So you should be knowing that this is going to lose, right? This is probably going to lose, and you're probably not going to have this money. So just be aware of that. But at least you have that safety, you have that insurance, and you have that hedge, right? As you can see it up here, probability of profit is 1.1%. But this is why it pays so much, because in that 99% chance that the market drops 20%, you have a chance of earning $8,500, which you could cash out. It saves your margin, by the way, because like I said, if you're a margin trader and the market crashes, you will be put into a margin call. This will save your margin. This will provide you money and cash that you could use to buy at a lower average cost while not having to hold cash, while not having to hold bonds. And you could just go ahead and have a safety net just in case there's drops like that. Now, last and not least, what if there's a 30% drop, which is very, very rare. We did have, as you can see, during 2020 COVID, where we had a 34% drop, right? At 2008, where we had a drop as well. If there's a 30% drop, the IB could go spike up to 80%. But let's say we'll go for like I don't know, let's go for 60, right? Let's go for a 60% IB spike. So let's change this to 60. Let's update the calculations. So this is using 5% of the portfolio. Let's go ahead and put this to 450 now. Hopefully it lets us do this range. 448. We're almost there. Actually, that's good enough. Actually, let's do a little bit lower. Let's do 440 if it lets us. So let's do 440. There you go. Perfect. So in case you have a 30% drop and you allocate 5% of your monthly income into your portfolio, into your hedging, right? So you use $150 in my case. If there's a 30% drop, first of all, you lose $25,500 in my case, right? So I'll lose $25,500 if I didn't have a hedge. But if you have 5% of your monthly income being used as a hedge, how much would you make? You would make $13,000. $13,000 if you just used 5% of your monthly income to hedge. That saves you $13,500, right? So $2,550 minus $13,500, right? Divide that by 85. That is only a 14% drop. You took a 30% drop and you halved it. You halved it, and now you only have a 15% drop in your portfolio. Not only that, but you could take that money, put it back into your account, and go ahead and grow at a faster pace than everybody else, because you took $150, turned it into almost, what is this? What was it again? $13,000 in cash that you could pull out and go ahead and invest it back into your portfolio, and boom, you're good. You're doing good. You're making good amount, lots of income, right? Because you bought SQYI, you bought QQQY at super low lows, right? And now when it's going back up and everything's spiking back up in a Nike switch, which usually the market does, or say even it's like a 2008 scenario where it takes a little bit of time to trend upwards, you're growing at a faster rate than everybody else, and you're having a higher return than everybody else because you did not have just cash on the sideline, but you had puts that were there as a hedge to protect you. And if it does happen, you go ahead and make all that cash as insurance. Now, we take a look at 10%, it's probably going to be even greater. So let's go ahead and go back, right? Let's go ahead and return back to what we had. We had 2550. Let's go back to that. Let's go ahead and change this to 440. So we had 440 as our lower, and we go ahead and take a look at a 30% drop with 10% of our monthly income invested. You'll make $15,000 if you had a 30% drop. So we take that and we subtract this by $15,000, right? We go ahead and divide that by our $85,000 portfolio. You would be at only a 12% drop. So as you can see, from a 5 to 10%, it's not that much of a difference from a 5 to 10%, right? So before it was a 14%, Now it's a 12% drop if you had a 10% of your monthly income invested. Actually, now I'm looking at it, that's with a 40% IV change. So what happens if we change this to 60? So let's change this to 60. How would that look? Let's take a look at this. If we had a 60% IV change, is it any different? Nope, it is not any different. It's still 15,000. So even if it's 40 to 60% IV change, the numbers will still be the same. At this point, it doesn't really matter if there's a 30% drop. The IV, I guess, does not change much in your portfolio, but $15,000 is how much you would be making in cash if you invested 10% of your monthly income, in my case, right? Which is $300. And if you invested 5%, which is $150 of your monthly income, then it would be $12,000. So the change is not much different. It goes from 14% possible loss to 12% possible loss on your total portfolio. So 5%, in my opinion, is the way to go. Of course, when it comes to smaller drops on the 5%, you are going to be making less, right? But when it comes to 10% drops on 5%, you'll make less. But on 10% drops on 10% of your income, you'll make a lot more, in around the 2,000 to 3,000 mark. While the 5% of your monthly income on a 10% drop will only make $1,000. But if you have those harder drops, 5 to 10% begins to really get very close to each other. The spread gets very small, very narrow. So not much of a difference when it comes to 20 to 30% drops, when it comes to 5% of your monthly income or 10% of your monthly income being invested. But like I said, for me, I'm choosing to do 5% of my monthly income of $2,872, for example, for August, using 5% of my monthly income to go ahead and hedge. And I'll continue to do that for now, because right now, I don't believe that we're going to have a drop maybe anytime soon, but if we do have a drop anytime soon, it'll probably be very strong. So that's why 5% is good enough for me. And that's why I'm okay with having this 585 put, because at the moment, in my opinion, there's not financial advice, but in my opinion, we are trending upwards. As you saw, we're reaching new highs on the S&P 500, right? 649.44, right? We're up 10.19%. But currently, in my opinion, that I believe that the market will continue to trend upwards. And are we going to get a 10% drop anytime soon? Maybe not. But if we did have a drop, I think it would be a strong and quick drop. Anything like the tariff type drops, where it's like 20% to 30% if we did have a drop. And it's not financial advice, it's just my opinion, that if a drop occurred, it'll be around the 20 and 30% range. And it wouldn't be a 10%, because at 10%, we would know that it would be coming and it'll be probably priced in, rather than 20 to 30%. So that's why I'm going at 5% currently of my monthly income. Will it go higher? Probably, but of course, the higher your portfolio, the higher income is, that means the higher your portfolio is worth. And of course, that means that 5% will still be continue to cover the same amount of percent. So therefore, you would need to grow that if you want to cover more of your portfolio. But anyways, that is this video. That is how I'm hedging my portfolio, just using 5% of my monthly income to hedge against the portfolio. And of course, you don't want to be hedging when the market is at its lowest, right? You want to use the strategy at times like now, where we're hitting all-time highs every single day, every single month, right? And we continue to be in situations where gold's at all-time highs, silver is at all-time highs, right? Silver is growing. We have job unemployment numbers coming in at all-time highs, right? People are getting fired from their jobs. There's less jobs being created. Debt is growing. So it's a very unstable market right now. I know it seems like we could only continue to go up, but in times of this, times like this where we only think the market go up, is times where you want to start hedging and looking at your portfolio and figuring out what is safe and what is not for your portfolio. So anyways, guys, thank you so much for watching. I'll see you guys next week for next week's video. We'll be going finally over Tesla and how much Tesla has returned on my total investment, and what is my total investment. And to do that, I'll be looking at documents from all the way back in 2023 when I initially started investing into Tesla. So anyways, guys, see you guys next week for that video, and thank you so much for watching my video about boring old hedging. See you guys.